performance, of course, brings up the topic of valuation. And Bruno, maybe I'll toss this your way. What do you think about GP valuations in the current market? It's been a lot of capital is invested at a very frothy, high multiple market, and things are a little bit different today. So I'm curious, and maybe bifurcating venture from buyout, because they are two quite different animals. So curious to get your thoughts.
First, which is, of course, valuation is related to the double-digit target. Of course, we still believe that private markets, mature private equity, must deliver to investors. Otherwise, it doesn't. The asset class would be no more interesting for an institutional investor. Having said that, it's important that we think, yes, it's possible to keep the double-digit, also because valuations are solid. But you have to split between existing portfolio, where indeed we believe the value is there, and mostly the restart the investing, producing capital gains. It's a matter of stability of interest rates, hoping that our central banks are going back to be policymakers and not just followers. But it's just my personal comment on the new portfolio. For the positive factors that we see going forward in terms of a more selective market, plus the fact that in the long term interest rates will be stable by definition, and the carried interest alignment will provide the right alignment between investors and managers, plus additional opportunities coming from companies that, of course, help troubles both on the revenue side or the financial side. And this is also, together with the reinsuring potential deal flow, it's produced additional opportunity. We believe that the double digit is there, must be there. And the solidity of valuation, also to consider that different from the financial crisis, where valuation private equity and private markets were much more correlated to public markets. Now the situation is fully different. In 2021, we had public markets going up, private markets did not follow. I'm talking on a broadly, with a broader comment, of course. And then in 22-23, market broadly down, private market still there. So the quite lower correlation we have today, it's also a key element to explain that good portfolio, well set, are just waiting that the stabilization interest rate is there to restart producing capital gains. And by the way, over the last 2 weeks, we have seen concrete in our portfolio a substantial restarting of deal makers.
Can I just say, though, I think the problem with private equity is not that valuations are too high, it's they're too low. I mean, I think on average, 70% of private equity exits are above the most recent mark. I think on average, it's something like 25 to 30% above across the industry. We've seen it as high as 50, 60%. So I think my CIO is a natural skeptic about private equity valuations, and I always remind him of this. And I think it's funny, we had an exit recently from one of our European managers, and I think it's the first time I can remember in years and years, it was below the most recent mark.
Huh.
I mean, I think they were holding it at 2.6 times and they sold it at 2.2 times. I was so astonished, I had to double check the numbers. I just couldn't believe it because it happens so rarely. So if you're an investor, you could say that NAV is not a great guide either, well, maybe it's current value, but certainly not to future or terminal value. So I think our industry is broadly conservative on valuations. Yeah. I think tech and growth is a whole other thing, but we're much more focused in the kind of core buyout space. So I always, whenever my CIO questions me about some valuations, I always remind him of these statistics. And I think most GPs think about the psychology of LPs, and they always prefer to surprise you on the upside rather than the downside. It's a much easier conversation to have.